Position sizing is a fundamental element in trading strategy. It involves determining the appropriate quantity of assets for each trade. This quantity is defined by the number of shares or contracts to trade. Effective position sizing is crucial for managing potential risks. It directly impacts the amount of capital exposed in any single trade. Therefore, it is a key tool for protecting overall trading capital. Position sizing is a risk management technique used in trading. The core principle is to limit the capital risked on any single trade. A common rule is to risk no more than 1 to 2% of the trading account per trade. This approach helps prevent substantial losses from individual trades. Position sizing requires an initial calculation of the risk amount per trade. This calculation involves multiplying the total account balance by a chosen risk percentage. Common risk percentages are typically set at 1% or 2% of the account balance. The resulting value represents the maximum capital to be risked on a single trade. Risk amount is determined by multiplying the account balance by the risk percentage. The risk percentage represents the portion of the account balance allocated to a single trade. For example, with a $10,000 balance and a 1% risk, the risk amount is $100. This calculation ensures that potential losses are limited to a predefined percentage of the total capital. Trade risk measurement is a critical step in risk management. It quantifies the potential financial loss associated with a trade. Trade risk is determined by calculating the difference between the entry price and the stop-loss price. The entry price is the price at which the trade is initiated. The stop-loss price is the predetermined price at which the trade will be closed to limit losses. This difference represents the potential loss per share or contract. Trade risk represents the potential loss on a single trade. It is determined by the difference between the entry price and the stop-loss price. The stop-loss is a predetermined price level at which a trade is automatically closed to limit losses. For example, buying a stock at $50 with a stop-loss at $48 results in a $2 risk per share. This $2 difference, $50, $48, is the maximum potential loss for each share traded. Position sizing is a critical step in risk management for trading. Step 3 involves calculating the position size based on risk tolerance. The calculation divides the predetermined risk amount by the trade risk. This division determines the appropriate number of shares or contracts. The resulting quantity aligns potential losses with the trader's risk parameters. Position size is determined by the amount of capital risked and the risk per share. The total risk amount represents the maximum capital the trader is willing to lose on the trade. The trade risk is the amount risked per share. To calculate position size, divide the total risk amount by the trade risk per share. For example, a $100 risk amount with a $2 per share risk results in a position size of 50 shares. Total position value represents the overall monetary value of a trading position. It is determined by multiplying the number of shares held in a position. This share quantity is multiplied by the entry price, which is the price at which the shares were initially acquired. The total position value indicates the total capital allocated to the specific trade or investment. Position value represents the total worth of an investment. It is calculated by multiplying the number of shares. It is calculated by multiplying the number of shares by the price per share. For example, consider an investor who purchases 50 shares. Each share is bought at a price of $50. The total position value is $2,500. 50 shares x $50 equals $2,500. The 1% rule is a risk management strategy used by traders. Traders risk only 1% of their total trading account on any single trade. This method is considered beginner-friendly due to its simplicity. The 1% rule aims to promote capital preservation and reduce emotional stress. The 1% rule is a risk management strategy used in trading. It involves limiting the potential loss on any single trade to 1% of the trader's total capital. Implementation requires using a stop-loss order to automatically close the position if it moves against the trader. Adhering strictly to the calculated position size based on the 1% risk is crucial. This approach helps to preserve capital and manage risk effectively over time. The 2% rule is a risk management strategy used in trading. It dictates that a trader should risk no more than 2% of their trading account on a single trade. This method is considered intermediate in terms of risk level. It is best suited for experienced traders who can identify high-probability setups. The rule aims to balance potential gains with the need to protect capital. By limiting risk, traders can withstand losing streaks and preserve their accounts. The 2% rule involves risking no more than 2% of trading capital on a single trade. Using the 2% rule necessitates careful trade selection due to increased risk exposure. A solid understanding of risk management is crucial when applying the 2% rule. The potential for larger losses is greater with the 2% rule compared to the 1% rule. Traders must be prepared for potentially significant drawdowns when employing the 2% rule. Effective risk control measures are essential to mitigate the amplified risks of the 2% rule. The 5-3-1 rule is a risk management strategy designed for active traders. It focuses on limiting overall portfolio risk and individual trade exposure. The 5 in the rule represents a maximum of 5% of total capital at risk across all open positions. The 3 limits the trader to holding no more than 3 open positions simultaneously. The 1 suggests risking no more than 1% or up to 2% of total capital on any single trade. This rule helps to diversify risk and prevent significant losses from any single trade or market event. The 5-3-1 rule is designed to prevent overtrading in financial markets. It also aims to avoid overexposure to any single trade or market event. This helps ensure that no single occurrence can critically impact a trading account. The rule provides a structured approach to risk management. By adhering to the 5-3-1 rule, traders can maintain a more stable financial position. Stop-loss orders are essential tools for managing risk in trading. These orders can be strategically placed based on various technical analysis methods. Support and resistance levels are common reference points for setting stop-loss orders. The average true range, ATR, method is another approach, using market volatility to determine placement. Percentage methods and candle methods offer alternative strategies for stop-loss order placement, depending on the trader's specific strategy. Stop-loss orders are placed to limit potential losses on a trade. Placing stop-loss orders beyond key support or resistance levels is a strategic approach. This placement protects against premature triggering due to false breakouts. It ensures the stop is positioned at a technically significant point, increasing its effectiveness. A common mistake is assuming any trade is a sure thing. No trade is guaranteed, and risk is always present. Overconfidence can lead to poor decision-making. Thorough research and risk management are crucial. Avoid the illusion of certainty in trading. Moving stop-loss orders wider to accommodate more shares is a common trading mistake. This action increases the overall risk exposure of the trading position. Widening stop-loss orders negates the risk management benefits of proper position sizing. Position sizing is designed to limit potential losses based on the initial stop-loss level. Therefore, avoid adjusting stop-loss orders to maintain effective risk control. Doubling down on a losing trade involves increasing your investment in the same asset after its price has already declined. The intention behind doubling down is to lower the average entry price. Doubling down typically amplifies potential losses. This strategy can quickly deplete capital if the asset's price continues to fall. It is generally advisable to cut losses early, rather than increasing exposure to a failing trade. A common mistake in trading is risking too much capital on a single trade. High-risk trades can lead to significant financial losses. It is generally advised to avoid risking 5% or more of the trading account on one trade. A bad streak of high-risk trades can quickly deplete a trading account. Managing risk is crucial for the long-term sustainability of a trading strategy. Prudent risk management helps protect capital and allows for recovery from inevitable losses. Ignoring correlations between positions can significantly increase portfolio risk. This is especially true for positions within the same sector. Correlated assets tend to move in the same direction. When correlations are ignored, diversification benefits are overestimated. This can lead to a portfolio that is more vulnerable to market downturns. Proper correlation analysis is crucial for effective risk management and portfolio construction. The "Can I sleep tonight?" test is used to evaluate appropriate position size in trading. This test assesses the potential stress caused by a complete loss of the trade. If the potential loss induces significant stress, the position size is deemed too large. Reducing the position size by half is recommended to mitigate this risk. Smaller positions reduce emotional stress and promote more rational decision-making. Always determine the stop-loss level before initiating a trade. Calculate the appropriate position size prior to buying any asset. Never adjust the risk percentage during an active trade. Prioritize the preservation of capital over the pursuit of profits. Effective risk management is crucial for long-term trading success.